Welcome to my channel kaf-e-zone. To watch more informative videos, subscribe my channel. International finance involves the study and management of financial interactions that occur between countries and their financial markets. It encompasses various aspects, including exchange rates, international trade, foreign investment, international capital flows, and financial instruments in the global context. Here are key components and concepts related to international finance. Foreign exchange market, Forex. The Forex market is where currencies are traded. Exchange rates, which determine the value of one currency relative to another, are critical in international finance. Exchange rates influence trade balances, capital flows, and investment decisions. Exchange rates. Exchange rates fluctuate based on supply and demand for different currencies in the Forex market. Factors affecting exchange rates include interest rates, inflation rates, political stability, and economic performance. Balance of payments, BOP. The balance of payments is a record of a country's economic transactions with the rest of the world. It is divided into the current account, trade balance, services, and transfers, capital account, capital transfers and acquisitions, and financial account, assets and liabilities. International trade. International trade involves the exchange of goods and services between countries. Trade balance, trade policies, tariffs, and trade agreements are crucial components of international trade and finance. Foreign direct investment, FDI. FDI refers to investments made by individuals, companies, or governments in foreign countries. These investments can be in various forms, such as acquiring a controlling interest in a foreign company or establishing new business operations. International capital flows. International capital flows involve the movement of funds across borders, including investments in stocks, bonds, and other financial instruments. It's essential to understand how these flows impact countries' economies and financial markets. International financial institutions. Institutions like the International Monetary Fund, IMF, World Bank, and Bank for International Settlements, BIS, play significant roles in stabilizing international finance, providing financial assistance, and fostering economic development. Hedging and risk management. Given the volatility in international markets, individuals and corporations engage in financial strategies like hedging to mitigate risks associated with exchange rate fluctuations and other economic variables. Multinational corporations, MNCs. MNCs operate in multiple countries and must navigate international finance complexities, including foreign currency transactions, financing, and managing risks associated with global operations. Sovereign debt. Sovereign debt refers to the borrowing and lending activities of governments on the international stage. It includes issues related to repayment, debt sustainability, credit ratings, and debt restructuring. Understanding international finance is crucial for governments, businesses, investors, and individuals involved in the global economy. Effective management of international financial interactions is vital for sustainable economic growth and stability across the world. User. International trade. International trade is the exchange of goods and services between countries or regions, typically facilitated by global markets and international agreements. It has been a fundamental aspect of the global economy for centuries and plays a crucial role in the economic development of nations. Here are key components and concepts related to international trade. Comparative advantage. Comparative advantage refers to a country's ability to produce a good or service at a lower opportunity cost compared to another country. Nations specialize in producing the goods and services for which they have a comparative advantage, resulting in increased overall efficiency and trade benefits. Absolute advantage. Absolute advantage occurs when a country can produce a good or service more efficiently, using fewer resources, compared to another country. Trade based on absolute advantage allows both countries to benefit from producing and exporting what they are best at. Trade surplus and deficit. A trade surplus occurs when a country exports more goods and services than it imports, leading to a positive balance of trade. Conversely, a trade deficit occurs when a country imports more than it exports, resulting in a negative balance of trade. Trade policies and tariffs. Trade policies are regulations and measures set by governments to manage and control international trade. Tariffs are taxes imposed on imported goods, often used to protect domestic industries, regulate trade, or generate revenue. Thanks for watching my video.